Hello and welcome to the latest news update on Canary News. Tesla finds itself at a pivotal juncture as analysts predict a potential downturn in sales due to softening demand for electric vehicles and rising interest rates. As the quarter draws to a close, analysts have revised their forecasts downward for Tesla's upcoming delivery report. There's even speculation on Wall Street about the possibility of Tesla experiencing its first sales decline since the early stages of the pandemic. According to a Bloomberg survey of analysts, the estimated number of vehicles delivered by Tesla in the quarter stands at 453,964 on average. This would mark a decrease of over 6% from the company's record-setting performance in the fourth quarter, which typically sees strong sales. The critical factor now is surpassing the 422,875 deliveries made in the first quarter of 2023 to avoid a year-over-year drop, a scenario not seen since the second quarter of 2020. Adding to the challenges, Elon Musk introduced a new directive in the final week of March that could potentially slow down the sales process. This directive mandates that every customer in North America must take short test drives to experience Tesla's driver assistance feature, marketed as full self-driving, which comes with a 1-month free trial. Despite offering incentives like temporary discounts and free supercharging, Tesla faces concerns about its growth outlook, particularly with the next-generation vehicle still in development. Analyst Emmanuel Rosner from Deutsche Bank has revised his delivery estimate downward twice in the past month, now projecting around 414,000 sales for the quarter, a 2% decrease from last year. These worries over volume and earnings could further weigh on investor sentiment and put pressure on Tesla's stock, which has already seen a 29% decline this year, the poorest performance on the S&P 500 index. Before we continue, please remember to smash the like button and subscribe to our channel.
Tesla also encountered operational challenges during the quarter, including factory shutdowns in Berlin and adjustments to its California facility for the production of an upgraded Model 3. In China, Tesla faces stiff competition from BYD, prompting adjustments to production schedules. Despite these challenges, Tesla remains a significant player in the electric vehicle market, with the Model 3 and Model Y accounting for the majority of its global deliveries last year. However, with uncertainties looming over its sales performance, Tesla's ability to navigate these challenges will be closely watched by investors and industry observers alike.
Check out our affiliated YouTube channel, Canary Comments, dedicated to insightful news analysis and thought-provoking opinions. Delve into the latest headlines with our team of expert commentators, who offer unique perspectives on current events from around the world. Join the conversation, stay informed, and broaden your understanding of the news landscape. Check out the link in the description below.
China's manufacturing sector surpassed expectations in March, sparking optimism regarding the nation's ability to meet its ambitious growth target of approximately 5% for the year. The Caixin Manufacturing Purchasing Managers Index, released on Monday, climbed to 51.1, marking the fifth consecutive month of expansion, the longest streak in over 2 years. Additionally, government data revealed a notable improvement, with the manufacturing PMI reaching its highest level in a year. Both figures exceeded market forecasts, indicating a strengthening industrial sector and bolstering hopes for an economic rebound. Following this positive news, China's benchmark CSI 300 index surged by 1.5%, the most significant increase in a month. However, trading in Hong Kong was halted due to a public holiday. Concurrently, the yield on 10-year government bonds edged up by 1 basis point to 2.31% in Shanghai. These PMI readings, considered a crucial monthly gauge of China's economic health, suggest that the country's recovery gained momentum in March, building on robust industrial output and exports witnessed in the first 2 months of the year. Amid challenges such as a property crisis, weakened consumer confidence, and geopolitical tensions, the industrial sector remains a beacon of optimism. Jacqueline Rong, chief China economist at BNP Paribas SA, noted that industrial momentum may have strengthened in March, even after accounting for seasonal factors. The surge in exports during the January-February period, fueled by a global trade upswing, has reignited hopes for improved foreign demand driving broader economic recovery. Signs of robust exports persisted in March, with the subgauge of new export orders in the official PMI expanding for the first time in a year. Meanwhile, broader demand saw an uptick, as reflected in the subgauge of new orders reaching its highest level in a year. To stimulate domestic spending, China has initiated measures to encourage consumers and businesses to replace old goods, promising government funds for this purpose. Despite not disclosing the aid's specifics, policies like large-scale equipment upgrades are expected to sustain demand for the manufacturing sector, according to Xiao Jinchuan, an analyst with Guangfa Securities. Moreover, data from the National Bureau of Statistics revealed a strengthening in non-manufacturing activity, with the gauge rising to 53 in March, surpassing economists' expectations. However, economists cautioned against the sustainability of the rebound, citing persistent weaknesses in certain areas. Lingering deflationary pressures, reflected in the contraction of output prices, continue to challenge companies' profit margins. Additionally, both input costs and output prices recorded their lowest levels since July 2023, according to the Caixin survey. While the overall economic recovery appears stable and positive, challenges such as subdued employment, low prices, and insufficient demand remain, emphasized Wang Zhe, senior economist at Caixin Insight Group. The job market reflects these challenges, with employment in the non-manufacturing sector shrinking to its lowest level in 5 months, and the manufacturing sector continuing to face a gloomy outlook for the 13th consecutive month. Chinese automakers are seizing opportunities in response to recent moves by Tesla and Xiaomi, aiming to both defend their market share and attract potential car buyers with enticing incentives. NIO, headquartered in Shanghai, unveiled a substantial incentive plan on Monday, allocating up to $138 million to encourage drivers of gasoline-powered vehicles to transition to electric cars. These incentives include benefits like battery swap services, additional subscriptions for assisted driving functions, and even the offer of a NIO mobile phone, as announced on the company's official Weibo channel. In a similar vein, Xpeng has slashed prices on select models by as much as 20,000 yuan, while Chery Automobile is covering purchase taxes on certain models and enhancing trade-in deals for customers' used vehicles. This proactive response contrasts with Tesla's recent decision to raise prices, particularly on its popular Model Y SUV. While Tesla's price hike was anticipated for some time, likely aimed at boosting demand ahead of the adjustment and bolstering first-quarter sales figures, local manufacturers are stepping up their efforts to compete fiercely in China's massive automotive market. Despite Tesla's prior warning about the price increase, reports indicate that the company had to reduce production at its Shanghai facility. This occurred as Tesla shipments declined in the first 2 months of 2024 compared to the same period last year, even as overall passenger vehicle sales in China saw an increase. Furthermore, these strategic moves from Chinese automakers come amidst the entry of consumer electronics giant Xiaomi into the EV market. Last week, Xiaomi officially launched its highly anticipated SU7 model, unveiling pricing details and commencing order intake. The response was swift, with pre-orders for the SU7 surpassing 88,898 within the first 24 hours, as announced by Xiaomi on social media. In summary, the automotive landscape in China is witnessing dynamic shifts as companies jockey for position amid changing consumer preferences and market dynamics. With Tesla, Xiaomi, and local manufacturers vying for attention, the competition promises to intensify, ultimately benefiting consumers with a wider array of options and incentives.
That is all the time we have for today. Tune in again tomorrow for the latest news update. Remember to like and share our videos. Also, please remember to subscribe to our channel. This will allow our videos to reach a wider audience. Thank you for watching.